Danger, Will Robison. Bidenomics inflation ahead. Let's look at some market forecasts. Hello, this is Chart GPT. Well, I guess the CPI number came out and was much hotter than people expected, giving Bidenomics another headache. Warning the markets. We'll take a look at these market forecasts in a moment here. Let's take a look at the numbers. So it came in at 3.5 year on year, hotter than expected. On the other hand, it's just a blip in the chart right now. You can see the little red circle there. But nevertheless, it's going in the wrong direction. They thought it was coming under control. So this is a problem. Let's take a look at some of the details. Some of the negatives were food away from home. That's restaurants, up 4% there. Electricity, 5% increase. And we have some transportation services and shelter going up there. Transportation service, 10%. That could be an effect of some of the supply chain issues. On the positive side, fuel oil had been coming down, and utility gas services coming down, but of course that could be going the other way with all the war talk. Because remember, this is maybe a few weeks old here when they compiled the data. Taking a look at the rate odds from the Fed, take a look at this red circle here, and these are the June rate cut that people were looking for, but no longer. You can see that the estimations is going more and more negative, so they're saying that rate cut odds has dipped to 18%, so it looks like they may just hold pat there in June and not cut. And of course you can see the out months, they think it's going to come down, but those are kind of wish lists there. So let's take a look at some markets here. Looking at the Dow here, it came off on those numbers, came off that high there. But I suspect if inflation is coming, then this would be an inflation head. So it might dip a little further here. I don't think it's going to take a roller coaster down and go higher. Of course, there's always a chance of a black swan event. It's got a lot of geopolitical events, because that's another ball game if that should happen. So I think we get a dip here and people buy the dip. And then where's we'll look at the 2 years. You see most of these in the 10s and 30s. But let's take the 2 year. It just spiked higher there. I think it could hit those highs, recent highs back in July of this year, and then bounce off, and then maybe go higher if the inflation isn't under control. Of course, there'll be a coordinated bank cut, but that's a whole other game. So what I think they'll try to do is Fed is going to try to thread the needle and not go higher, not go lower. But we'll see if they can do that, because obviously they can only do that if inflation stays tamer. So we'll see where that goes. I think on the currency markets, kind of interesting that I use the yen here, but you can see all those currencies are trading in pretty good sized wedges, and the dollar took a rise there. But here's the one that I look at this, the yen here, and it popped through it, the triple top, and so that's since 1990. So when you see one pop through, the other in wedges, some of them haven't broke yet, but I suspect the dollar is going to gain here, because if interest rates are perceived to be going higher, that's going to be dollar positive. So I point that out on the yen. Gold suffered because obviously when you have higher interest rates, it tends to be negative on gold and commodities, but they didn't come down that much, so people are still afraid of it. So where are interest rates going? Well, Jamie Dimon, the market guru or market manipulator, warns that U.S. interest rates could rise to 8%. Now, we have some debate out there whether or not rates are going higher or lower or staying the same. But 8%, well, take a look. This is the problem for Bidenomics here. I showed this chart before, but I've added something to it, the projection of a 300 Fed rate rise. Here the had a projection of 150 basis Fed cut. But if they're going to rise to 8%, we're talking $2.2 trillion of interest payments alone of the federal debt. People say, well, this has happened before. Well, no, it hasn't. I mean, we've never had this much debt, carrying this much debt. If you raise interest rates, it's a huge amount of payments. That means a third of our budget will be going to interest rate payments. And, of course, that means it's going to be a huge problem for the budget people there on the federal. So there's a little thing here where he says, well, what if we raise rates or lower rates? If we raise rates, the budget shortfalls will trigger more political spending, because they have to make up the difference. So they just have to spend more money, which means more money printing, which means more inflation down the road, even though it could be down the road. Obviously, the recession fears if you go to 8%. If we cut rates, then we do have the inflation fears, and of course that'll kill the dollar. So there'll be a de-dollarization, and you create asset bubbles. Can we thread the needle? This is what the Fed, I think, would probably do, try to keep interest rates and go on hold here and see if they can go on hold and inflation will calm down on its own, which I'm not sure is true. But anyway, go to the post link in the description box and take our online poll. Will interest rates explode to higher rates than we've seen in decades or not? Take a look at what the higher consumer price index rate can have on the effects on financial markets in the AI write-up. Again, follow that post link in the description box. Now don't forget to subscribe.